Good morning, Marcus, and welcome back to the Real Assets Roundup studio. It's great to have you back in here with us. So you're the portfolio manager on Catalyst Hedge Solutions, and I understand you have a qualified investor hedge fund, which has actually just reached its 20-year track record, which is phenomenal. And then there's the retail version of that, which largely mirrors that. But for those that have never come across your strategy before, or perhaps investors that have actually dabbling within hedge funds for the first time, in plain terms, and I know you hedge fund managers love your jargon, but in real plain English, how would you describe your strategy and where it fits in portfolios?
Morning, Kerri. Thank you very much. Yeah, so the Catalyst Hedge Solutions, essentially what they try to do is outperform a cash benchmark, so it's got an absolute return hurdle. We utilize local, listed, and global real estate stocks. What we really like about it is the uncorrelated nature between local property and global property, even more so when you overlay the rand portion of the global returns. It's a long biased fund, but then it's a long short equity fund. So
what does long bias mean?
So long bias means that it just will have a bias towards being exposed to the market rather than being short the market or equity market neutral. So where we tend to operate is sort of between the 35% net exposure to about 95% net exposure range, with a neutral zone around the 2/3 invested, 65% exposure. What the fund then does do is go long short, be in cash, increase gross exposure, increase net exposure, or vice versa. So at its core, it's actually quite a vanilla hedge fund, just being long short equities. That being said, from time to time we will utilize derivatives, currency futures, etc. in our strategies, and we will also look to be a little bit more active in special opportunities such as vendor placements, or be a bit more active in our activist shareholding, etc. etc.
Interesting. Thank you. I think it would be remiss to not look at Q1. I know we are already in Q2 heading towards the middle of the year, but Q1 was yet again another turbulent start of the year. We've had this same Q1 story for about 5 years in a row now. And it was quite interesting to see, if you look at February and March, so obviously we know the Middle East tensions peaked at the tail end of February, but the ALP was up around 7%, and your fund largely tracked that in February. But then come March, and diminishing, or the market just turning on its head a little bit, your fund only took up about 48-50% of that downside. Now, is that an anomaly? Is that a one-off thing for your portfolio, or is this an expectation of your portfolio and how it tracks against the ALP, for example?
So I think there's a couple things to unpack here. Firstly, I think the fund at its core always will try to, outperform a cash benchmark through every cycle. It utilizes local and global property as its tool set to do so. So while we do reference the underlying market, our objective is still just to outperform cash and give the best risk-adjusted returns through the cycle. Obviously, when you have a nice case study like we had in Q1, it is nice to reference the market because, previously to that, especially in SA equities and SA property, markets were going up largely in a straight line. So that's where hedge funds almost they tend to underperform a sort of a vanilla tracker or just the underlying index. But then when you have these periods of volatility like you had in March with the Middle East conflict, that's where a hedge fund can really show its mettle and show its worth. So what we saw going through February is just on fundamentals, while SA property was still on strong footing with good distributable income growth, a lot of the stocks had moved through value. Bond yields in South Africa had come all the way into 7.75 yield to maturity on the 10-year and about 7.15 on the 5-year. So we were opportunistic that just with what had happened in the market, even pre the conflict, the fund had decreased materially its exposure to SA Inc. In addition to that, we had shorted some government bonds because they were actually a very attractive funding source to redeploy into SA listed property. The currency was exceptionally strong against the dollar, so we had, brought our currency hedging quite far back so that we were exposed to a weakening ZAR. And we had at the tail end of last year already, taken out some synthetic exposure because volatility was exceptionally low. You could actually get downside protection quite cheaply. So all of those things had sort of set us up quite well to be defensive in a negative market. Obviously, we didn't expect it to play out the way it did, but it just happened to be that the portfolio had these tools available and had implemented these tools such that we could go into March well protected. Like I said, all of those tools, having a short government bond, which obviously protects you in an SA Inc. sort of risk-off environment, that contributed nicely. We took the opportunity to close our position in the synthetics because they had done their job to protect capital on the way down. And by this stage, our exposure to SA Inc. was only about 25 to 30% on an equity basis. In addition to that, our offshore holdings, they actually, while they also sold off, all global markets sold off, by having a lot of our currency unhedged, we actually got the benefit of the currency move out from 15.90 to about 17.20. And then obviously on this sell-off period, the hedge fund is extremely active. If you look at Q1, the portfolio, when it comes to active management, almost churned 100% of NAV just in one quarter. The opportunity there was after the first 2 weeks of March, when the market had sold off north of 10%, there was this period of sort of volatile but sideways movement in the market, even when negative headlines were hitting, which sort of gave me quite a lot of comfort that even in a big downside scenario, the likelihood of it was very low and that it was almost already priced in. So then the fund again opportunistically, increased net exposure again. We added the currency hedging to protect against if there was going to be a strengthening ZAR or a weakening dollar again. And reintroduced some net exposure. There was an element of risk to it, but obviously the upside was that it then captures the upside if there is a little bit of good news from the Middle East conflict. While we haven't gotten a full resolution, the ceasefire did come through, and I think Trump's taco trade, Trump always chickens out, showed that there was at least a willingness to engage. Who knows how it goes from here, but I think the worst case scenario of nuclear warfare or a ground invasion or this becoming World War III, that has largely subsided. So when you look at March again, the fund captured about 120% of the upside of what the ALP did. So in summary, 100% of the upside in a strong February, protected by only capturing 45% of the downside in March. And then in April, we captured 120% of the upside again in April of the All Property Index. So I think what ends up happening is the thesis remains true. We don't actually try capture 100% of the upside. We just want to capture more of the upside than we do the downside. It is a long biased fund, so there will be some correlation to the market. But where you find yourself now after April, is that the fund is at all-time highs, whereas the ALP is still about 6 or 7% behind its last highs in February. So I think it's a good advertisement of how the fund, we don't try to make money when the market goes up and make money when the market goes down. But if we can limit the downside in the negative times, you just have to work that much less hard to capture the upside in the next cycle when the cycle turns.
It's amazing. It really shows the beauty of hedge funds. And it's funny how for so long it's always got a bad rap of being this risky addition to portfolios. But you've just described perfectly that having hedge is actually brilliant because there's so many toolkits and levers you can pull to actually minimize the downside. It's very difficult to, have core themes at the moment because the market moves so fast. You've just described, within weeks you're changing the portfolio based on current news. Are there any particular sectors or themes or SA versus global property right now that you're leaning into that you feel comfortable with, given that the macro is still so uncertain?
Yeah, it's a very interesting question because largely, the fundamental story we had at the beginning of the year when it comes specifically just to real estate fundamentals, that's largely unchanged. If you look at previous crises like COVID or, an inflation cycle or an interest rate cycle, it immediately impacts listed real estate. Right now, while you have had a little bit of a tick up in inflation, the fundamentals are still exceptionally strong within South African real estate and in a lot of subsectors globally. The one piece of the puzzle, though, because at its core, Catalyst picks stocks based on a fundamental analysis. It's a 5-year or 10-year discounted cash flow with an adjusted hurdle rate as your, to determine a relative value, where you then get a conviction whether you buy a stock or short a stock or stay out of a stock. Right now, the piece is we're comfortable with the numbers. The piece that we are probably a little bit more uncomfortable with is the risk side of it, so the risk-adjusted return. So while I think there is heightened risk and probably more downside risk to earnings over a 5-year period, our stock picking, I guess, hasn't changed that much. But what we have done is probably on the hedge fund side, you're a little bit safer in cash right now. And as we have heard, I'm sure a lot of people, it's very topical, is that, at the beginning of the year, central banks were speaking to continued rate cuts. Now rate hikes are back on the conversation. So if you have rate hikes coming through again, the knock-on effect of that will be that listed real estate sells off. So we're cautiously, optimistic that hopefully there's a quicker resolution to this and that you can go back to the fundamental story, which is actually quite strong. But in the short term, we do actually increase our cash. And remember also that in a hedge fund, if the interest rates start hiking, it just makes cash more and more desirable. So, getting 6 or 7% from cash isn't a bad outcome for your investors or your clients, especially when the macro environment is so uncertain.
We talk about outcomes, looking at that 20-year track record for the QIF. And as I've mentioned before, the RIF largely is mirroring that, but it has a much shorter track record. If you look at actually how it's grown over the last 20 years, it's almost at about a 20 times multiple. So $100 invested in 06 is now roughly 2,000 Rand in today's terms. You don't get there just by random luck and by fluke. And I appreciate you haven't been on the strategy for the entire 20-year duration, but you've been schooled in that train of thought and you've worked alongside the original portfolio manager for years before you took over. So was there a core principle that's run across that entire 2-decade period that has led to where the fund is now and been able to give clients these, fantastic outcomes?
Yeah, so it's actually not planned, but it makes a great story, that the fund is at its 20-year anniversary in Q1 this year, and you've made 20x your money. So it is a great advertisement of the product. I've worked alongside my predecessor, as an analyst for about 5 years before taking over as portfolio manager 4 years ago. So I've been, close to the product for, call it, half its life. Yeah. So a lot of the principles and the styles and the way of running it and what remains important are instilled in me. And it's amazing how your behavior changes when you have your own capital in the fund and when you are a shareholder in the business. I think it's a very easy story to tell that, protecting capital is at the core of this fund's mantra. I think it's extremely sexy, obviously, to have a 5 or 6 times levered fund that when the market is going well, you're doing 3x what the market does. But, best believe you're not sleeping very well when a crisis hits. And there's obviously the behavioral trend also of, losses feeling worse than gains feel good. So I think over the last 20 years, if I was to say that there's one thing that is instilled in us, is just that you have to protect capital. Now, obviously, you can protect capital by just being in cash for the rest of your life, then you're never going to make any returns. So there is an element of, you have to take an element of risk to generate the returns. But if you can just protect capital well in the negative drawdown periods, you have to work that much less harder, like I said, in the recovery periods. So if there's one thing I would say, is just a fierce, relentless, vehemently, disciplined approach to capital management and capital preservation. And then, when the cycle turns, you just position that much better. You're not clawing back from this deep rut.
It all comes back to the beauty of compound interest, time in the game. Thank you so much, Marcus. I appreciate you stepping away from your busy office life to come join us for a little bit. If anyone wants to reach out and find out more about the fund, I imagine they can get hold of you, and as well as me, I'm the head of distribution, and we'll pop the contact details down below.
Thank you so much.